Hey guys, Philip Schadler here, a local real estate agent in Los Angeles, and let's dive into some real estate data. This is my report for September 2023. There is some interesting chatter going on in the real estate industry. So I've been talking to some people, been in Zoom meetings and so forth, talking to brokers, mortgage brokers, have been in the industry for a long time. And some of them seem to think that by summer 2024, the interest rates, the mortgage rate might jump to 10%. Now that would be quite outrageous, and I just don't think the Feds would do this. I just think it would be a very extreme measure. And the reason being is because it's already the high interest rates and the sharp increases they've had in the past is already affecting several industries and the mortgage industry in general. Mortgages, new applications are down 45 to 50%, and refis are down 88%. So really, when you think about it, that is cutting your business more than in half. And one company like this one, for example, mortgage lender, AmeriFirst Financial files for bankruptcy. There's a mortgage company in Arizona that just filed for bankruptcy. And it's very, very sad because obviously there's a lot of things tied to it when that happens. The employees are losing their jobs, and this is something that could only be a single case. But what if it is something telling for the future? And again, I don't want to be a fearmonger. I personally don't think that's going to happen because the projections from other sources are quite the opposite. We've had, and let's just look at the reports real quick over here. We've had home prices are slightly higher than they were a year ago, and some people are believing in the industry that that is going to be a continuing trend because of low inventory. However, now think about it. If you had a 10% interest rate all of a sudden, right? That could really spin a lot of businesses into turmoil. And because a high interest rate, even now there's credit cards that have 25, 27, and even 30% interest rates, which I've heard, which is insane. So if more layoffs would happen because of that in the mortgage industry, and there's a lot of related businesses to the mortgage and real estate industry, they would all kind of trickle down. That could lead to layoffs. And if you have layoffs, then people, doesn't matter if you have a 2 or 3% during COVID, it would probably be fair to assume that these people would lose their mortgage, lose their house, which then ultimately would add inventory to the market. Obviously, this is not a great way to add inventory. Some people think this could be by design. I tend to think that's not the case. I want to be on the positive vibe. But if it would be, that would be kind of evil, to do it. But because obviously if you had a high interest rate, sales would go down even further. And what also would happen, prices would come down. If prices come down, then equity comes down. And this is why I'm saying that if this scenario, I'm just saying if, I don't think it's going to happen, but if that scenario would come to light, then there would be a window of opportunity for home sellers to sell between now and springtime, because beyond that, the equity might go down. So you might actually wait too long. And again, this is more an idea to just keep an eye on rather than trying to be a fearmonger, because some of these things can come up very quickly. And if people are not prepared, then it could be a dire situation for certain homeowners. So let's see what they can do to be prepared. For one thing, I would recommend that they would obviously pay off the credit cards. Have no balance would be ideal. If you can pay it down to zero, that'd be possible. And also, by being aware of the situation, there's really three scenarios for a homeowner in distress, the three routes that I can think of that a homeowner could go. Well, one obviously is to throw the keys at the lender, but then you're losing everything. You're walking away from the home, and this has happened before. This is, if you go back, even though it has nothing to do with 2008. In 2008, frivolous loans were written, and the originators of those loans knew that the people couldn't pay them back. So that's a whole different story. Here we have low interest loans. People refi it, and there is a large percentage who sits on a 3-4% interest rate, fixed, 30 years fixed, right now in America. So. But if let's say somebody would lose their job, and what could they do in order not just to walk away from a home? They could have an assumable loan situation. And during COVID, obviously this was nothing ever even talked about because it would never make any sense and people didn't even know about it. But an assumable loan is basically where somebody steps in that has a good credit score and takes over your payment. Now, I hope that you don't know anybody that is going through that, because it's quite sad and dramatic and stressful. but there is ways to save your credit, and this would be with an assumable loan. Now, first of all, you would have to find out, is the loan that you currently have even assumable? As far as I know, I'm not an expert in loans, but as far as I know, VA loans, FHA loans are assumable because they are guaranteed by the government. Conventional loans are not guaranteed by the government, so they may not be assumable. But assumable loan would only make sense, obviously, if your rate is lower than the current rate. So let's say somebody purchased a house during COVID at 3%. And remember, during COVID, a lot of people overpaid, so they may not even have positive equity in their home right now because they may have paid 100, 200,000, or 50,000 above asking price because it was such a frenzy. But let's just say, so let's say the 3%. Now, currently we're at 7.3%. So of course, somebody would be interested in taking over that loan, but you wouldn't get anything. Maybe you might be able to squeeze $10,000, $20,000 out of it from the second borrower that's going to assume your loan. And I would probably structure it in such a way that if the second borrower is late with payments, the ownership would go automatically back to the first borrower. Now, you are still on the hook as the first borrower if the second borrower doesn't pay. So there's something to be aware of. There are ways, I think, to structure it in a way where you have less responsibility. But the benefit would be you would walk away from the home and still have good credit. And at some point you want to repurchase, that is going to be very crucial to do so. The other way would be, for example, my brokerage, eXp Realty, I'm a certified express offer agent, which means we work with investors and they have what's called a buy box. And the buy box is basically their criteria. If, let's say, the distressed person's home falls in that criteria of a buy box of an investor, then it will be my job to go in and offer that distressed person a deal. And obviously it's not the best price, but this is designed to get out of a situation that could ruin your credit and really make your life more difficult in the future if you want to purchase again. So we would make an offer, and it's a cash deal. There's nobody walking through the house other than me, and it would be probably 10 to 15 days escrow. It's a cash deal, and that's it. There's no repairs done. You would sell the house as is. It's a fairly simple process. I'm not saying it's not stressful for the distressed owner, but anyway, this is just a situation that could do the rest. The other thing would be to throw the keys at the lender, but then everything is gone. So again, that's not really what I recommend. Now let's look at some of the inventory here. We have current inventory right now. We have 509,156. This is by Altos Research. And as you can see, that's very low still, because if you look at the dark line, that's currently now 2023. If you look at the lighter mauve, pinkish color, which was 2022, I would estimate that we're going to shoot straight to the right, and I think there's not much inventory gain towards the end of the year. We only have a few months left, so I would think we end up at the same or similar number that we did last year, which is around 500,000. Now remember, let's look at the numbers here. 509,156 is really not a lot, and you can see that by, I did the assumption here, total single-family residences are about 82 million in the United States. Total residences, this includes condominiums, townhouses, and single-family residences, are 142 million. Now, if you look at the numbers, 509,156 is a very low number come out of 142 million. And in a healthy market, you would have to have 1.5 to 1 or maybe 2 million properties in the market. That would be a very healthy 6-month supply. By the way, also I want to mention real quick, we have the listing in Santa Monica, the 2218 Pico Boulevard. It's a commercial listing, mixed use zoning, and at the bottom is business. The top 2 floors are residential, and it was built in 1945. Current footprint is about 2,700 square feet. Current living space is about 3,000 square feet. There is an upstairs, downstairs. There is an office downstairs. There's a 1-bedroom downstairs. There's a studio upstairs and a 2-bedroom upstairs and a large garage. The total lot size is 4,500 square feet, and it's listed at $2.4 million. So if you know somebody that is an investor or has interest, this is a great investment opportunity because it's literally 5 minutes walking distance from the Santa Monica College. And there's a beautiful, recently remodeled Virginia Avenue Park straight across the street. So for future residents, this could be amazing. And there's lots of shops and cafes to walk around. And it's a great area. It's a great potential for an investor. I would think it's for redevelopment. I mean, you could use it as it is and fix it up, but I think a redevelopment would make most sense. Now let's have a look real quick at current. Currently, this gives another idea. This is total single-family home spending contracts per week. So we only had 54,000 new pending sales this week, which is 40% fewer than last year. So definitely, some people have just been kicked out from the mortgage rates. So if they were approved at 6.5 and all of a sudden, it went to 7.5, their lender calls them up and says, I'm sorry, you no longer qualify for this loan. So that has happened as well. Again, the high rates don't really help the market well at all. Let's look at really quickly what could happen. Let's go back to the 10% scenario. What could happen if the rates would really go up to 10%? If the Feds raised rates to 10%, it would have a significant impact to the U.S. economy. Here are some of the most likely effects. Housing market slow down. It would slow down even more. Higher interest rates would make it more expensive to borrow money to buy a house, which would likely lead to a slowdown in the housing market. This could lead to lower home prices and fewer home sales, which means lower home prices means a decrease in equity. Again, I don't think that scenario is going to happen, but if it does, then it would be wise for the home seller to know this, to act before, because you could either sell between now and springtime 2024, or you just wait it out until the end of it when things change again a year or two down the road. It could also mean weaker consumer spending. Higher interest rates would also make it more expensive to borrow money to finance other purchases such as cars and appliances. This could lead to weaker consumer spending. This would slow down economic growth. Job losses. If the economy slows down, businesses may be forced to lay off workers. This could lead to higher unemployment. So again, if people are suffering from the sharp increase of the interest rates, it would slow down, obviously, the real estate market, but it could also have effect in other businesses where people may lose their jobs. Stock market decline. Higher interest rates can make stocks less attractive to investors, which could lead to a decline in stock prices. Recession. If the economy slows down enough, it could even lead to a recession. A recession is defined as 2 consecutive quarters of negative economic growth. The exact impact of 10% interest rate hike would depend on a number of factors, including the overall state of the economy and the reaction of businesses and consumers to higher rates. However, it is clear that such a large hike would have a significant impact on the economy. Again, I don't think this is going to happen, but I'm just telling people, be on the lookout for it. If you are considering selling, and I would love to be interviewed by you and show you in 10-15 minutes how my action plan would work to sell your house for the most amount of money. And I can also offer your sellers this brochure here, Things to Consider When Selling Your House. It's a 24-page PDF file, which has very valuable information for home sellers if you're considering selling your home. Just send me an email, and I will email you this PDF file at no charge to you. It's free. Anyway, if you have any, one more thing I want to mention, because some people obviously have been leaving California and are considering leaving California, or they have already. And here is a list we compiled of the 10 best states that people move to, or the best 10 states people want to move to. And I've had, actually in the last year, I had 11 clients who moved to Boise, Idaho, to Charlotte, North Carolina, to Florida, to Texas, and Michigan, so other places. So they seem to be, I talk to them occasionally, they seem to be happy with their choice. But here's the list of the 10 most desired states to move to. Wyoming is number 1, Vermont, South Dakota, New Hampshire, Massachusetts, North Dakota, New Jersey, Maine, Florida, and Washington, the first 10. And some of the concerns are obviously crime and safety, and the ever-growing homeless population, for example, here in California, is an issue for a lot of people. But the people we've talked to, parents, have also mentioned that they're really concerned, or they want to move into a state where they seem to have a little bit more control over their child's education system. So the schooling of American children is becoming a very important deciding factor, besides safety and homelessness, for parents to move into certain states. And you can see up there on the map, it shows you in green where this is favorable places to move to, where the red and orange are not so favorable. This is where people are leaving from. If you need to, or if you are looking to relocate, again, please let me know. I can help you, and I would love to show you how we can get the most amount of money out of your property in the next 9 months. And also, if you need to relocate, I know a great agent in Charlotte, North Carolina. I know some great agents in the Miami area in Florida, and also in Boise, Idaho. I know somebody that are great agents, and they would love to help, because sometimes it's really, really important to have a great real estate agent on your side so that you can save lots of money. Thank you so much for watching. I appreciate your time. And again, if you have any questions real estate related, either DM me or call me at 310-918-2260. Thank you so much for watching.